Good morning and welcome. The hearing will come to order. I apologize to everyone at the outset. I've had a nasty head cold for a couple days, so if I sound like I'm in a tunnel, I apologize. I want to thank our distinguished panel of witnesses who have taken the time to be here today. Special thanks to Karen Madonia, who hails from the 8th Congressional District of Illinois. We look forward to all of your testimony. I will begin with some brief comments. Benjamin Franklin is believed to have written, "In this world, nothing can be certain but death and taxes. Now it seems nothing is certain but uncertainty." For many years, death and taxes have gone together in the United States, but the structure and rates of those taxes have varied greatly. For family-owned small businesses and farms, estate taxes are a significant concern. Isn't it enough for them to worry about new and higher taxes, compliance with the health care law, additional regulations, accessing capital, and simply staying afloat while they are alive? But these small business owners must also try to blunt the impact of estate taxes following their demise. If Congress fails to act by the end of this year, the current federal estate tax law will revert to significantly higher pre-2001 levels. And that's not including any estate taxes imposed by states. Many small companies have non-liquid assets, capital that's tied up in real property, machinery, and equipment. So their heirs do not have cash to pay the estate taxes. Often businesses must be sold, even at fire sale prices, so this estate tax can be paid. In fact, a Joint Economic Committee study found that prior to 2001, the estate tax reduced capital formation by about $847 billion. Capital that must be paid in estate tax is capital that is not available to be invested back into the business, to create jobs, or to grow the economy. Today, we will hear about the effects of the estate tax on small business owners. We very much look forward to this testimony. I now yield to our ranking member for his opening remarks.
Thank you, Mr. Chairman. For many, starting a successful small business, or farm actually, and seeing it grow is the American dream. After all, the goal of most of these entrepreneurs is to build an estate that they can pass on to the next generation, carry on the family dream. But for many who have spent their whole lives building an enterprise, continuing that legacy tends to be very problematic, given the estate tax. For many family businesses, the estate tax is a major hurdle to overcome, very technical, very complex. Planning around such intricacies is expensive, time-consuming, things that most small business folks don't have time or the money for at the end of the day. Additionally, it just adds anxiety. You have to constantly update your financial plan because of what we do or don't do here in the United States Congress. And while the estate tax reforms enacted in 2001 allowed entrepreneurs to focus on growing their ventures, the reforms were only temporary. In 2010, we were able to give some estate tax relief, but again, very temporary, just for 2 years. With the existing law expiring, as the Chair pointed out, at the end of the year, reduced exemption limits will take effect, subjecting many more small businesses and farmers to the estate tax. So providing relief for thousands of small firms and farms is critical to continuing the recovery. However, we must be cautious how we do that, because we do have a debt and deficit issue that we are also concerned about. As our economy continues its recovery, we must do everything possible to help small business job creators. We cannot do so at the expense of future generations. So today's hearing will assess the implications of the estate tax on small firms and farms and examine what the future of this law holds for them. Some are calling for a complete repeal of the estate tax. Others suggest that Congress freeze the estate tax provisions in their current form. Nevertheless, one thing's clear: we need a permanent solution. So look forward to hearing from each and every one of you what you think that might be. Small businesses face enough hurdles to succeed without the estate tax. Protecting the family business so it can flourish is critical to creating American jobs and the future of this country. And by crafting a estate tax that works for small firms and farms, we can empower entrepreneurs to do what they do best, which is create jobs. So I look forward to hearing from each and every one, and yield back, Mr. Chair.
Thank you, Congressman Schrader. If it's okay with you, Congressman King has to dash off to a meeting in a second and requested the ability to make an opening statement. Congressman King.
Thank you, Mr. Chairman. And Mr. Chairman, I very much appreciate you holding this hearing today. I think it's important that we have this discussion. I appreciate the witnesses a great deal. I'd like to start this out with a little piece of a narrative, and that was just a few years ago, I received a phone call in an evening from an individual whom I knew to be one of several siblings in a well-to-do family, not that far from where I live. And he started out with this: Congressman, I drew the short straw, and I'm the one that has to call you. Our mother is in the hospital, and we're making a decision on whether to put her on life support, and I'd like to know whether Congress is going to do something to fix the death tax. Ladies and gentlemen, it is cruel and diabolical to put families through this and make death also a taxing decision. And it's cruel and diabolical to tap into the accumulation of the American dream. If we can tax it when they earn the income, we can find ways in our states especially to tax it when they spend it. We don't need to tax it if they accumulate it. And I, as a founder of a construction business back in 1975, started out with a negative net worth and built a little bit of capital. Now I've transitioned that into one of my sons at a minimum, who has demonstrated to me that it isn't just intergenerational capital that we develop, but we also accumulate intergenerational knowledge. You build a knowledge base within the family. They learn things at age 10 that I didn't learn till I was 40. And that foundation of this is how you tie together the American dream. The American dream is tied together by people come here to the United States to access this American dream. They're raised to access the American dream. The pillars of American exceptionalism are tied together to paint the foundation for the American dream. And what does the federal government do but go in and grab it at each transfer of the generations? And why do you build that? Why do people go to work after, say, age 50 or 55 if they're able to take care of themselves for the rest of their life? Why do they continue to work and succeed if the government's going to take the proceeds of that wealth? And so this death tax, this estate tax that we're dealing with here today, it is a tax directly on the American dream. It takes the capital out of the formation, out of the family. And for example, a family farm, just think of a family farm that over 2 or 3 or 4 generations has accumulated maybe 1,500 acres and set up a grain leg distribution system, storage system, and feedlots and pastures and all of those things that go together to make a unit. And then that unit is broken up to pay the taxes, and the entire family business is destroyed. Because what? Because of the political element in this country and in this Congress called class envy. We should cheer the people that are able to achieve and succeed in the American dream and understand that we want to encourage more of that, more capital formation, more wealth formation, more families, family businesses where you have the accumulation of intergenerational capital and the accumulation of intergenerational knowledge. That's my message today, and I hope I can hear the witness's testimony, and I'm hopeful that we'll be able to move forward and one day see the end to this tax on the American dream called the estate tax.
Thank you, Congressman King. If other subcommittee members have an opening statement prepared, I ask that they be submitted for the record. To our witnesses, you'll each have 5 minutes to deliver your testimony. Do your best to adhere to that time limit. We will begin with our first witness, Neil Katz, who is managing partner of the law firm of Katz, Bernstein, and Katz in Syosset, New York. Excuse me. He specializes in federal and state income tax issues and matters affecting corporate partnership, estate, and gift taxation. Not only are his clients small business owners, but he is part owner of a small business himself. He practices law with his father. Welcome, Mr. Katz. You have 5 minutes to present your testimony.
Good morning, Chairman Walsh, Ranking Member Schrader, and members of the subcommittee. I appreciate the opportunity to address you today, and I thank you for taking time to learn about the difficulties faced by closely held business owners as a result of the imposition of the estate tax on the business that they have worked tirelessly to create and grow. Your hearing memorandum states in its conclusion that there is not a great deal of credible evidence about the effect of the estate tax on small businesses. While there may not be a significant number of empirical studies on this issue, the business owners who will testify today and the millions of small business owners across our country who are struggling with this issue are all the credible evidence that you should need. Closely held businesses are an integral part of local economies throughout the country. Business owners spend their entire lives investing time, effort, and capital into making a business a success. Many of them would like nothing more than to be able to pass the fruits of their labor and capital on to the next generation. However, as business owners age, the complexities of owning and running a closely held business often become overshadowed by the burden of the estate tax looming on the horizon. The issues faced by business owners and their families start long before death, with the necessity of seeking out professionals to assist with planning to attempt to reduce the exposure that the heirs will face. This planning does not come without a price. To design and implement an estate plan can cost an individual anywhere from $5,000 to $50,000 or more. The plan may call for the transfer of interest in the business to future generations. Often, this decision is one that the owner may not be prepared emotionally or economically to make at that time. During the planning process, business owners are forced to familiarize themselves with the concept of estate tax valuation, and the families need to become prepared for the expediency with which estate taxes must generally be paid. Estate tax value is a concept that accountants, attorneys, legislators, and the Treasury Department have struggled with for decades. There's no clear definition in the statute, and the only guidance we are given is the hypothetical willing buyer, willing seller language of the regulations. Tax experts often differ on the meaning of these rules, and to business owners, this is often impossible to comprehend. The real value of a closely held business is often tied directly to the owners. Ask most business owners what their business is worth in the market, and they will say, without me, the business is worth nothing. Where estate tax valuation differs from reality, it only makes the burden on the business owner and their family even greater. When I was younger, I started collecting baseball cards, and today I still have much of that collection in my basement. Whenever I'm asked why I don't throw out the baseball card collection, I say that it's because it's worth a lot of money. To that, my wife inevitably responds, it's actually not worth anything unless you sell it. To most small business owners, the same principle applies. To them, the only value of the business is the check that they get to take home each week. However, the estate tax valuation concepts force an imposition of a tax as if the business were sold. Further complicating matters is the requirement that the estate tax be paid within 9 months of death. While extensions are available, they are often short-term solutions to a long-term problem. Even Internal Revenue Code Section 6166, the most significant estate tax extension, has its problems. Most businesses do not have the cash reserves or cash flow available to make the payments that are required in the time frame, and many businesses do not qualify for this relief. Planners will thus often recommend that a business owner acquire life insurance to provide liquidity to pay the ultimate estate tax that will be due. This creates an added expense to the business. Depending upon the amount of insurance that is required, the premiums can run tens of thousands of dollars annually if the owner is even insurable. Businesses today are operating on very tight margins. Adding the burden of estate tax to the cash flow of the business can make continuing the operation of the business impracticable. The new owner of the business can often not afford to pay taxes and still have money to pay business expenses and make a profit. Most individuals do not see working to solely pay off an estate tax obligation as the definition of the American dream. There's no benefit to a beneficiary if the assets that they inherit provide them with nothing other than the opportunity to work with no expectation of income. There needs to be some incentive for the owner. As a final point, more than anything, what the small business owner needs is some clarity and certainty in the law. The constant changes in the estate tax law over the past 12 years, coupled with the uncertainty of the future rules, is unworkable. Congress needs to once and for all establish rules that business owners can be assured will survive. Since the enactment of EGTRA in 2001, we have been operating in an impossible environment. The chaos of 2010, which again stands before us on January 1st, 2013, cannot be repeated. Business owners and all taxpayers need and deserve certainty. Thank you again for the opportunity to speak today. I'm happy to answer any questions the members may have.
Thank you for your testimony, Mr. Katz. Our next witness is Karen Madonia. Ms. Madonia is Chief Financial Officer of ILCO, Inc., a family-owned distributor of refrigeration, heating, air conditioning, PVF, plumbing, and hydronic supplies in Aurora, Illinois. She currently serves as co-chair of the Government Affairs Committee of the Heating, Air Conditioning, and Refrigeration Distributors International. She is testifying today on their behalf. Welcome. You have 5 minutes to present your testimony.
Chairman Walsh, Ranking Member Schrader, and members of the Subcommittee on Economic Growth, Tax, and Capital Access. My name is Karen Madonia, and I am the Chief Financial Officer and next generation of ILCO Incorporated, a Chicago area distributor of heating, ventilation, air conditioning, and refrigeration equipment, parts, and supplies. Thank you for giving me the opportunity to talk about the estate tax and its effect on the many small family businesses which make up the United States economy. This is an issue that's very close to my heart as my family is in the midst of our own generational transfer. As background, ILCO was a very small company when my father purchased it back in 1973. At that time, my dad was only 32 years old with a wife, 3 daughters, and a mortgage, but he knew he wanted something more than just a job. He wanted to use his passion to create something permanent, to be in control of his own destiny. With help from my grandfather, my dad decided to take a risk and go into business for himself. In those early years, he worked every job at the company, and my mom filled in wherever needed. My dad worked 7 days a week, 10 to 12 hours a day. But his passion for the industry, his commitment to his employees, and his drive to grow his company empowered him to push forward, and 40 years later, he has a business that employs over 90 people in 3 states and generates almost $40 million in revenue. My sisters and I grew up understanding that if we wanted to be successful, we had to work hard and stay focused on our goals, and we carry that ethic with us every day as we work alongside our dad. While I take great pride in my dad's story, I realize that it's not necessarily unique. There are thousands of families that have similar histories, families who have decided to risk everything to pursue the American dream. Like my dad, they want to create something that lasts and that can be passed down to their kids and grandkids. I'm speaking today about my own family's experience, but I know that all family business owners have the same issue. How do I pass this business on to future generations without losing some or all of it to the IRS in the form of estate taxes? Each spring, I come to Washington with our trade association, Hardy, to talk to our representatives and senators about the issues that are important to my company and our industry. Every year, estate tax is my top priority, and I appreciate this committee's interest in this issue. Far too often, small business owners feel that there is a lack of understanding about this tax and its impact on job creators. The reality is that we're not talking about passing on bank accounts with million-dollar balances. These are businesses where most of the net worth is tied up in inventory, equipment, and real estate. In the case of ILCO, we carry an inventory valued at $10 million and accounts receivable of about $5 million. Our inventory has to be high. We provide vital heating, air conditioning, and refrigeration, parts and supplies to hospitals, schools, nursing homes, and grocery stores. When the refrigeration system in a grocery store goes down, it needs to be repaired within hours or the food is lost. When the air conditioning system in a hospital doesn't work, patients cannot be properly cared for until air is circulating again. The products that we sell must be on hand in order to facilitate quick repairs and replacements, which means that we have to carry a heavy inventory. We also own 5 buildings and operate a fleet of 26 trucks. After paying our taxes and making our annual profit-sharing contribution, the income that's left is put right back into the company so we can continue to carry an extensive inventory, extend payment terms to our customers, and maintain our fleet and our buildings. If something happened to my dad, we would literally have to sell parts of the company in order to pay the estate tax. That would likely mean shutting down branches, laying off workers, or liquidating inventory. Even worse, it could mean having to sell the entire company just to be able to pay a tax bill that only occurred because an owner died. Over the last few years, my dad has spent countless hours and entirely too much money trying to navigate the estate planning waters. Instead of focusing on growing his business, he has had to strategize about how to pass his company on to his kids without having to dismantle it. And if that isn't enough of a challenge, he's had to do it within an ever-changing tax landscape. We've gone from an exemption of $2 million and a tax rate of 45% in 2008 to an exemption of $3.5 million and a tax rate of 45% in 2009, to a full estate tax repeal in 2010, to an exemption of $5 million and a tax rate of 35% in 2011 and 2012. In 2013, the exemption is scheduled to fall back to $1 million with a tax rate of 55%. How can anyone formulate an estate plan if the rules are changing every year? In the business world, we need to think beyond the current year if we want our companies to thrive. We're typically looking 5 to 10 years out in our strategic plans trying to move all the pieces on the board to better our chances for growth and prosperity. That's very difficult to do even in the best circumstances, but it's nearly impossible when Washington keeps changing the rules. The estate tax places an immense burden on small business owners by taxing them for creating and growing a business that outlasts them. In my opinion, it's a fundamentally flawed tax that discourages entrepreneurship, and it should be totally repealed. Absent that, I would ask that Congress consider maintaining the current personal exemption and gift and estate tax rates, and equally important, establish a more permanent solution to the estate tax issue. Small business owners take tremendous risk at great personal sacrifice, and they truly are the backbone of the American economy. They should be appreciated and encouraged. Allowing the estate tax exemption to fall back to $1 million and the rate to climb to 55% would absolutely devastate a great number of families who are currently working on generational transfers. I respectfully urge you to carefully consider all the ramifications of estate tax policy and establish a long-term solution that will allow for generational transfers of family businesses. And I thank you for allowing me to put a more personal perspective on the issue for you.
Thank you, Ms. Madonia. I now yield to Mr. Hanna, who will introduce our next witness.
Hello, Mr. Flesher. How are you today? Our next witness is Mike Flesher. Mr. Flesher is president of the American Rental Association. Mike Flesher was born and raised in the southern tier of New York. I have the privilege of representing many communities there. He operates 2 Taylor Rental Centers, franchises in upstate New York, truly family-owned businesses. They provide taxes and opportunity and jobs in those communities. Last week, I had the opportunity to visit his business in Vestal, New York, to discuss the impact of taxes and his ability to hire and grow and plan. Welcome, Mr. Flesher. You have 5 minutes.
Thank you, Chairman Walsh and Ranking Member Schrader, and thank you, Representative Hanna, for that generous introduction. Mr. Chairman and members of the subcommittee, I am Mike Flesher, President of Taylor Rental in Vestal, New York, and President of the American Rental Association. I am here today to testify on the effects of the federal estate tax on small businesses. Taylor Rental is a small family-owned business with 2 locations in Vestal and Ithaca, New York. Taylor Rental is a typical rental business. We employ 16 full-time and 4 part-time employees and up to 15 seasonal employees. ARA has approximately 4,000 members in the United States, and the overwhelming majority of them are businesses just like mine. We rent equipment and tools to contractors and homeowners, and we rent party and event equipment to individuals and corporate clients. ARA supports a permanent extension of current estate tax law, which allows a $5 million per person exemption indexed for inflation and a 35% rate on the remaining assets in the estate. Current law also provides for a stepped-up basis on assets in the estate. It is critical for Congress to pass a permanent extension so that small businesses have the certainty we need to plan for the future. We are concerned about the federal estate tax reverting to the $1 million per person exemption and 55% rate that existed in 2000. My testimony shows the number of rental business locations and the economic impact of the rental industry for each state represented by a member of the Small Business Committee, illustrating how ubiquitous the equipment rental industry is throughout the United States. According to IHS Global Insight, the equipment rental industry in the U.S. will generate $31.2 billion this year and $49.8 billion by 2016. The industry is currently growing 4 times faster than the U.S. GDP. Much of this growth is from the expansion of small businesses within the industry. What does it take to generate billions of dollars in rental revenue? It takes capital, and a lot of it. Collectively, ARA members have billions of dollars invested in the equipment our customers want and need. An 80 by 160-foot tent that gives a young couple the dream wedding they always wanted cost me $60,000. Taylor Rental has hundreds of tents that range from $1,000 to $60,000 each. Other equipment like small Bobcat loaders cost $34,000, and aerial work platforms can cost $50,000 to $100,000. Larger equipment like track excavators can cost well over $150,000 per unit. Equipment rental companies make ongoing capital investments to survive and grow because customers demand the latest and best equipment. When you rent a car, you do not usually get a 1990 Buick. You get a new car with low mileage. The same is true in the equipment rental industry. My customers do not want old equipment. They want new equipment, and I must invest in that equipment to satisfy my customers. U.S. equipment rental companies are investing $10 billion in new equipment this year and almost $20 billion annually by 2015. Along with the billions invested in equipment, we own real estate and buildings that house our rental stores and equipment. Many small equipment rental businesses have substantial but illiquid assets. This is precisely why ARA is concerned about the possibility that the current estate tax law will expire on December 31st, 2012 and revert to 2000 levels. If the estate tax reverts to 2000 levels, my estate would be severely impacted. 16 good people who have given our company many years of good service may no longer have a job. The businesses that sold products and services to our company could lose a good customer. But foremost, the economic security of my family will be uncertain. Mr. Chairman, there's a lot of rhetoric about how the estate tax really only affects rich people. I do not consider myself or my family rich. For the past 43 years, I've gone to work every day to make a living. I have invested my resources in a company that has grown and been successful despite some tough times recently. My estate is my company. I do not have assets that can easily be liquidated to pay estate taxes. My company will have to be sold. Reverting to a policy that was outdated 12 years ago would, in my opinion, be a disaster for many small business owners like me, and the #1 goal that I have worked for will be in jeopardy: to provide financial security for my family. In addition, the current situation makes business planning almost impossible. We need certainty on the estate tax, and we need it now. Let me be clear. ARA would eliminate the federal estate tax. It is a tax on capital, pure and simple. However, the need for certainty on this issue has led us to a position of supporting a permanent extension of current law. We believe the current $5 million exemption with a 35% rate and stepped-up basis is a policy that will help sustain small businesses for years to come. Thank you, Mr. Chairman. That concludes my statement. I will be happy to answer any questions you may have.
Thank you, Mr. Flesher. I now yield to Ranking Member Schrader, who will introduce our final witness.
Thank you very much, Mr. Chairman. It's my pleasure to introduce Thalia Rolnick, certified public accountant with offices in Arizona. Her practice concentrates on tax planning and compliance for high net worth individuals, partnerships, and closely held businesses. Ms. Rolnick also chairs the IRS Liaison Committee and serves as a member of the Board of Directors for Valley Estate Planners. Thank you for being here.
Thank you. Chairman Walsh and Ranking Member Schrader, thank you for inviting me. As has been said, I've been practicing in Phoenix, Arizona at the estate issues for the last 16 years. The estate tax has been with us since the early Egyptians in 700 BC first initiated. The first U.S. estate tax dates back to 1797. Those in favor say it's an effective tool to raise needed revenue and to prevent the concentration of wealth and power in a few families. Others believe that it discourages capital accumulation and curbs national economic growth. The question with us today is, can a small business survive the estate tax? And the answer is, it depends. The estate tax has been a moving target since 2002, when the amount that could pass estate tax-free first increased from $600,000 per person to the current $5,120,000 per person. At the end of this year, it will drop back to $1 million unless Congress acts. The exclusion amount enacted will determine how many businesses are actually affected. In 2010, when the exclusion amount was $3.5 million, according to IRS statistics, 4,425 small business owners' estates paid some sort of estate tax. This is approximately 0.02% of all business owners. Yet the total estate tax collected was over $69 billion. At a $5 million exclusion, even fewer businesses will be subject to the tax. If the Congress allows the exclusion to revert back to $1 million, based on 2002 numbers, almost 26,000 small businesses will be subject to the tax every year, and now it becomes a very big small business issue. When the current estate law was passed in 2010, it attempted to reduce the need for some of the more complex estate planning techniques. It tried to go ahead and make the exclusion amount more of a family amount by allowing for portability. While the ideal was admirable, the legislation is flawed in many ways. First, it only applies to the estate tax and not to the generation skipping tax. So if I want to leave assets to my grandchildren, they will be taxed. Second, to be eligible, the estate must file an estate tax return Form 706. This is very complex and takes a lot of time and energy. The statute of limitations then remains open on this for the life of the surviving spouse. That could be 5, 10, or even 15 years, long after any documentation for how the values were determined are gone. If the surviving spouse remarries, the inherited additional exclusion may be lost. Finally, if the inherited assets increase in value, the surviving spouse's estate may be subject to estate tax that would not have been subject to estate tax had those assets been placed in an irrevocable trust at the time of the first of death. The current code provides favorable provisions for small businesses. Section 2032A provides that land used in a business or a farm can be valued at its current use rather than its highest value. If the land stops being used in this way or sold within 10 years, the additional estate tax is assessed. Section 6166 allows the estate to pay a portion of their estate tax attributable to a farm or closely held business over a 15-year period if the value is greater than 35% of the estate. Section 2057 is currently obsolete, but if the estate reverts back to $1 million, it will become active again. It provides an additional exemption to small business owners, but the calculation cannot be done prior to death and therefore cannot be relied on for during estate planning stages. In addition to the items identified, a number of important estate issues will also expire, and I have those listed in my written testimony. Most business owners are very resourceful and find ways to resolve business issues, but when they don't know what to plan for, planning becomes impossible. There can be no planning until we have some permanence. Therefore, I recommend enactment of a permanent estate and gift tax with an exclusion someplace between $3.5 million and $5 million, adjusted for inflation along with step-up in basis. Permanently rejoin the gift and estate tax. Make portability permanent, but also correct the existing statute to allow a surviving spouse to accumulate up to a full second exclusion. Allow portability for generation skipping tax. Change the statute of limitations for these returns to 3 years. Recommend that the IRS develop a simple Form 707. Preserve reasonable valuation discounts for operating businesses where the death of an owner truly reduces the value of business. Pass a simpler, easier provision to provide small businesses with an additional exclusion. My recommendation is in my written testimony. Pay for these provisions by restoring progressivity to the estate tax at levels above the exclusion amount. Reform the grant-to-retainer annuity trust provisions to disallow excess discounts where the trust holds primarily liquid assets. Thank you for your time, and I'd be glad to answer any questions.
Thank you, Ms. Rolnick. I appreciate your testimony. I'll begin with a couple questions, and then I want to hear from the rest of the committee. This issue of the estate tax is probably an issue that I hear of and about when I'm back home, probably as much, if not more than any other issue. I spend a lot of time, as many members of Congress do, speaking to small business owners, and this is always top of mind with them. Why is that? Well, because they feel it. There's a real negative impact. Mr. Flesher, you said it. I'm going to borrow that line from you. My estate is my company. Bingo. I hear that constantly. So this is a tax that directly impacts small business owners. The other reason, though, why I think this tax is such a big tax with people back home is just philosophically. It makes people scratch their heads. Look, we're taxed when we make money. We're taxed when we grow businesses. We're taxed when we buy things. We're taxed when we invest. When we die, just the thought that when we die, Ms. Madonia, when your dad works his tail off for 30 to 40 years to grow a business, why does the government get to put their hands on any of that money? I think it's the broader philosophical question that annoys a lot of people, even people who aren't impacted by this tax. I hear that constantly. The amount of money that the government raises with this tax is not a large amount. But the headaches that we put people through to do it is just amazing to me. Can anybody answer that question? Just philosophically, what's the rationale for this tax? Let's, and like everything in Washington, we get right down into the X's and the O's. Well, we can improve it. We need to extend it by 5 years, drop the exemption down to here, maybe. I don't even want to play that game. I won't with my questioning. Why do we even have this tax? Can anybody make the case on principle that it's a good thing for the government to take money from you when you die? Anybody want to take a stab at that? Mr. Katz? You know you're itching to answer.
I'm not sure that I can necessarily answer it philosophically, but I think that I can at least give some insight as to the historical perspective of it. I think when the estate tax was first enacted, there was a tremendous sense of needing it for a redistribution of wealth, for avoiding some of the accumulation, the mass accumulation of wealth by some of the larger landowning and wealth-owning families in the country. And I think to some extent the estate tax has survived all of these years, not based upon its economic impact upon the tax coffers, if you will, but it has survived based upon the theory that there needs to be some way to move wealth from those that continue to accumulate it to those
Why?
other.
Why?
I think to some extent it's the same reason why there is larger income tax rates on people who earn more money. It's the same theory that goes back years and years of trying to move money down to fund social projects, to be able to have funds available to help those who haven't, for whatever reason, been able to help themselves. And I think to some extent the estate tax has the same impact as the progressive income tax.
Well, I think you're right, and I think the reason this resonates with people is because of when it occurs. I mean, that's basically the basis for most taxes in this country. But this really hits a number of intersections because you're talking about something so personal, so intimate, a family's death, a business owner's death, and at that moment, here comes the hand of government in to grab something. Ms. Rolnick, is there any just overarching justification, anything you want to add?
I basically agree with Mr. Katz. Basically, it was set up to go ahead and prevent certain families from accumulating the most amount of wealth and the most amount of power, and therefore going ahead and allowing two classes of people, those with and those without.
So the world now has changed because now we're at a point where Ms. Madonia said, and how poignant is this? If something happened to my dad, we'd have to sell the business. How in God's name have we gotten to that point in this country? Maybe with the best of intentions. We have this thing called the death tax, where you have to look a member of Congress in the face and say, if something happens to your dad, you're going to have to sell your business. How is that a good thing? How is that a good thing? And so is the answer, Mr. Flesher, Ms. Madonia, I'll let you two chime in here, is the answer to tinker with it so that maybe your dad, maybe your family doesn't have to pay that consequence? Tinker with it, improve it? Or has the world changed that now so impacts small business owners that we should just get rid of it? Mr. Flesher.
Well, I support a full repeal. I've paid income tax over the life of my equipment, and I've paid state sales tax to the state every time I rent a piece of equipment. We've been taxed over and over again on the life of that equipment and my entire business. I don't believe we should be taxed again. We support the current bill because we think that's a possibility, and we think that would help the majority of our members in ARA.
Ms. Madonia, what's your thought or recommendation there?
I guess I would just share a story. I have a nephew. Our family business is my parents, my sisters. We have a next generation of 8 grandkids, and one of those grandkids said at one point, when we talk a lot about this in our family, and one of them said to my dad, why would I want to do this? Why would I want to start my own business? Why would I want to work really hard like you have if it's just going to be taken away from me when I'm done? Why not just be another guy? Why not just work for somebody else? And that's really sad. I mean, this is the United States of America. It's the land of opportunity. It's where people can have a dream and turn it into reality, and to discourage that in any way. And I think the estate tax is a major discouragement to that, and I just think it's fundamentally wrong.
Well, and you are right in that studies would buttress your argument. The estate tax has a major negative impact on entrepreneurial activity. And again, that just makes sense. If you're going to, again, work your tail off year after year to grow a business, and then as you all said, you need to begin to play this game, Mr. Katz, where every year you've got to spend money to figure out how, when the ultimate happens, you can, as much as possible, pass money down to your kids and your family. You have to spend resources to try to do that. That's mind-boggling to me. I will end there and turn to Ranking Member Schrader for his questions.
Well, thank you, Mr. Chairman. Okay, one alternative that I will point out is you sell your business that you built over time. That's what I ended up doing. I was a small businessman at a small veterinary practice, and either I wasn't home enough or didn't imbue my kids enough with a faith in veterinary medicine they were not interested in following, so I ended up selling mine, and it was my retirement, as many of you have talked about, either through an estate planning technique or, as in my case, where you sell it. But that's another thought for the younger generation, so he's not totally discouraged with being an entrepreneur at the end of the day. Great testimony, and one of the takeaways I have from this, Mr. Chair, is it's a little similar to what we had in the last Congress when we talked about the estate tax. And, you know, while many, if not everyone at the dais would probably want to repeal the estate tax, if at all possible, we are facing a little debt and deficit issue, trying to balance our own checkbook here, believe it or not, the United States government. It's encouraging to hear that the values that were enacted in 2010, albeit temporary, were of value to your different constituencies. Could Mr. Flesher, Ms. Madonia, Mr. Katz talk about real quick about the $5 million, $10 million, the stepped-up basis, and the 35%? In terms of the number of businesses like yours, you think, you know, you said majority, Mr. Flesher, is at 60%, 50%. Well, we're just guessing. I understand there may not have data. Good.
Maybe 90 to 95%. The majority of our members are in the $500 to $3 million range.
Okay.
But of course, in being indexed, that would help as those businesses continue to grow. If it reverted back, that's a hard. You know, we have revenue numbers, but we don't know their values, so it's hard to say what that number would be.
How about Ms. Madonia? What do you, if we kept at least the current area?
Well, I think part of the equation also has to be that $5 million isn't just the value of your business. That's the value. That's your value. So now you're talking about somebody's profit sharing in 401k that they've accumulated over the course of time. You're talking about their house. All of that has to fall in that $5 million. So. Again, I think it's a fundamentally flawed tax that should be repealed altogether. Is $5 million more workable than $3.5 million or $1 million? Absolutely, but it's still not as much as you think it is when you've got a small business and then you've got your retirement savings in your house and any other assets you've accumulated.
Sure, Mr. Katz.
Being from the metropolitan New York area, I think things are slightly different and slightly skewed in my view. People who live in my area, you take the businesses that they have and add the value of those businesses to the value of their homes and the value of the other assets and that we need to accumulate in order to be able to afford to live in the area that we live in. Although $5 million is certainly helpful, there are still going to be a large number of people that are going to be subject to the continued estate tax, which is why I think that moving more towards some of the discussion that Ms. Rolnick talked about earlier in her testimony relating to some special exemptions for small businesses to try to remove the value of some or all of the small business out of the computation of the estate tax would be helpful. If we had a $5 million exemption to cover home and personal savings and 401ks and all of those types of things, and then on
It's my
top of that,
understanding, actually, that the 401ks and the homes are already deductible from the estate tax.
no,
They are included?
they are absolutely included.
Good to know.
So if we had that exemption to cover those assets, and then an additional exemption to cover part or all of the value of a closely held business, I think that to that extent we would be able to solve some of the problems. Mr. Flesher talked about his estate being his business. If you have multiple exemptions or an exemption just for that business, he's not going to have the problems that he's facing right now.
So follow up then with 3 members. Ms. Rolnick gave some great recommendations, which I really appreciate at the end of her testimony in written form and alluded to them in her oral discussion. Have you guys had a chance to read those at all? I, for one, Mr. Chairman, would be interested in your comments. I'm sure you have access. We can make sure you have access to her testimony because it covers a lot of the things that Mr. Katz, Ms. Madonia, and Mr. Flesher are talking about. These it might be things we'd want to recommend to our Finance Committee folks, our Ways and Means folks to look at as we get down to crunch time at some point, hopefully before Armageddon sets in and we actually do some things with our tax code that are absolutely critical, even beyond the estate tax itself. So with that, I guess I'll yield back, Mr. Chair.
Thank you, Mr. Schrader. I now turn to Mr. Hanna from New York.
Mr. Katz, you and I both live in New York. I know the answer to this, but I want to hear you say it. What's the lifetime exemption from New York?
The lifetime exemption, well, it's a combination lifetime and death time exemption, is $1 million.
Right. What is the marginal rate on that for a deceased family?
The highest estate tax rate in New York is 16%.
So the possibility exists that in New York, for Mr. Flesher, what looks like 35% at $5 million is really a minimum of 16 once you reach a threshold of $1 million, and so that his effective rate will be 16% on that additional $4 million plus 51% on everything over that 5. You may want to reconsider, Mr. Flesher, whether you like the 5 or not. Were you aware of that, Mr. Flesher?
I was, but I didn't consider it part of this testimony here.
Right. Well, the interesting thing is that New York State has lost a lot of its population over the last few years. It's certainly not growing as fast as other states. And one of the reasons is that there are other places that are more inheritance tax friendly. So the people who have accumulated wealth have a disincentive to stay in New York. And I imagine it's generally that way any state in the country that has a higher rather than lower inheritance tax. The limit seems to be the problem. Certainly people who have $1 billion or multiple $1 billion, you may want to think differently about that. I know, like, for example, Bill Gates' father is very much in favor of a inheritance tax. But what we're talking about here is small businesses and how to preserve them and their wealth accumulating, job hiring, machinery, and that there is also a cost to society in general to the money that Mrs. Rolnick was talking about the government collects. Because if you dismantle a business that's been 40 years in the making, how have you really helped your community or your country? So I wonder about the $5 million limit, if it's enough, and if it's really the question. Perhaps a larger question is, do we want to tax it at all? Apparently some people don't. I'm open to discussion about that, but I do think that even the $5 million is a low limit, and to fix it at that limit, and with the, you talk about irrevocable life insurance trusts, these are huge expenses. I personally have friends who spend hundreds of thousands of dollars trying to figure out how to protect their estate. They go through multiple gyrations and put themselves at risk, give away property before they're ready to do it because, you know, they're still alive and they would really like to stay in control, but our government doesn't allow them to do that efficiently. So, I don't know, is there anything you'd like to say about that, Mr. Katz, being from New York?
Well,
think one of the other issues that in a way that Congress hurt states like New York was when they modified the estate tax law to eliminate the state death tax credit and change it to a state death tax deduction. Prior to the change in the law, whatever you had paid to a state like New York would come 100% off the top of the estate tax bill that you would pay to the federal government. By changing those rules and making it now just a deduction, you're only getting the effective rate benefit of that, costing people that live in states like New York and other states that do have their own independent estate tax significantly more money than
Effectively paying a tax on a tax.
Effectively.
Right. Thank you very much. I yield back.
Thank you, Mr. Hanna. I now turn to Ms. Clark from New York.
Thank you, Mr. Chairman, and I thank the ranking member. I thank all of you for your testimony here today. And I find it a very good and very important conversation, and the testimony here today will help inform many of us as we look at how we address this issue going forward. Economic certainty is something that we all desire, particularly for small business, where we recognize the value that you have in all of our communities across the nation. And I want to just say that what is so unique about our nation is that it provides this opportunity for entrepreneurship like no other nation. And it's the American dream. It's the reason why the United States, I believe, is the greatest nation on the planet. But having said that, I have a question, and I think it may even go to the philosophical to a certain degree. Do you, and this is directed to the entire panel, do you think that the unique opportunity provided by our nation has a value beyond compounded wealth accumulation? Or do you believe that those who have benefited the most from this unique nature of the United States owe something back to the country that provided them the opportunity to enrich themselves? I heard Ms. Rolnick's requirements and her proposal, but from everyone else, and I'm sorry, Mr. Katz, I came in during your testimony, I heard that nothing should be paid. So I just wanted to get some further insights from you because of the unique nature of our nation, the way that we can basically build ourselves from the ground up. Sweat equity builds and accumulates wealth over time. Is there something that's we feel obligated to in terms of the nation? And how does that reconcile itself with this demand for the estate tax?
I'll start. I guess I would argue that small business owners are already giving back because we're employing people. We're buying equipment from companies that are employing people. I mean, by the very nature of being a business owner, you are giving back. I mean, you're paying your taxes all along the way as you're earning money. We've got 90 employees that are part of our family. You know, we take care of those employees. We provide their health insurance. We, contribute to their retirement accounts. We're already giving back just because we're business owners. Can you just stick a
pin in that? Your employees also help you to be a thriving business.
Absolutely. Which is
so it's a symbiotic relationship, and they too are paying taxes, right?
Absolutely.
Okay.
I agree with that. That was a great comment. I think we're putting back and giving back every single day economically. But I'm very proud of my country. I served in the military, and we do have to do our part. There's no question about that. But there is a limit to it. And when you're taxed over and over again, and then you get what's left, you want to hang on to that. And I think that's the situation here, and it's pretty simple. I mean, we've paid taxes over and over again, and we don't want to not pay any taxes. We don't want to not do our part. We want to be part of the United States, the country that we're so proud of, and but we don't want to be taken advantage of either.
From a philosophical point of view, I guess I need to run it right down the middle for a few seconds, because clearly there is an obligation on behalf of all of us who have managed to accumulate to try and help those who are less fortunate than us. Certainly understand the business owner's perspective of they've worked hard. Ms. Madonia's father works 7 days a week, 12 hours a day, and to accumulate wealth and should have the opportunity to be able to maintain as much of that as possible. I think that there are probably economists that are a lot smarter than myself who would be able to go through and tell you what the economic aspects of all of this are. But what I can tell you is that from what I see, as much as anything, it's the administration of the rules and the uncertainty of the rules that have created so much problem for people. Business owners do budgeting, do planning, they do it every day. If a business owner were to know exactly what their opportunities were and know that if something happened in 2012, it would be a certain rule, and if something happened in 2013, it would be a certain rule. What happened in 2010 was chaotic. Changing rules in December, in the middle of December, going back to January of that year, we can't operate like that. You can't ask business owners to be able to plan and budget for rent and health insurance and all the other things, but at the same time not know what the tax is going to be at the end. So whatever Congress ultimately decides, whether it's 3.5, whether it's 5, whatever, just pick something. Just pick something and let that be the rule. And let everybody who's sitting at this table and all the people around the country who are operating businesses and all the accountants and lawyers who are advising people know what the rules are and know how the rules are going to be applied.
I thank you for your testimony. I think this gets to the heart of the challenge that we face as legislators, understanding and relating to all that you give, and then looking at what we can do in terms of fairness. I think at the end of the day, we want to be fair. We know that you are the economic engines of our communities. I come from an entrepreneurial family as well. I also understand the obligation that we have one to another and would want to try to maintain those obligations as best we can, given where we are economically as a nation. So thank you for your testimony.
Thank you, Ms. Clark. And I would only add that, Ms. Madonia, I want to keep saying this, so I apologize. If something happens to your dad, you'd have to sell your company. 90 employees, so I don't know how having to let 90 employees go is anybody's definition of giving back. Let's turn to Mr. Bartlett of Maryland.
I'm honored, sir, that you let me sit in on your subcommittee, but I think protocol says that I go last.
Okay, thank you. Rookie chairman. Let's turn, hey, Bobby, you're up. Let's turn to Mr. Schilling of Illinois.
Thank you, Chairman. I'd like to thank each and every one of you for being here today. I'm also, like a few of there, a small business owner. And one of the things that I find very frustrating is the fact that the federal government can come in and take 55% of your estate. I used to do death tax planning, and you know what? We've got to stop calling it estate tax. Call it what it is. It's a death tax. The last person dies, the survivor dies, you've got to go in there. And so many times I would go out and I would see the families have to go in and spend $10, $20, $30, $40, $50,000 a year to make sure that they could keep their business or their farm. I guess the first question that I would like to have, and any of the folks on the panel could answer this for me, is do you believe that the death tax hurts or helps businesses in the United States of America? Let's go with Mr. Flesher.
It absolutely hurts them. I mean, you talk about the planning process and having certainty. Even with that certainty, we still have to plan and we have to adjust. We don't know how long we're going to live. And our states still change every year, irregardless. So it's like a double whammy. I mean, it's tough to plan for that future anyway. But with the uncertainty of having this tax over your head, it's impossible. You can't do it.
Yes.
I was just going to add that it takes a lot of time and resources away from your business, too, in those years where you're trying to figure it all out, trying to figure out how to pass it on. I mean, my dad has spent a significant amount of time over the last few years just trying to figure this whole thing out and find a way to pass on his company. That effort could have been spent focusing more on the business. We could, those resources could have been used to expand the business, hire more people, buy more equipment, open another branch. So it does, it's not just money, it's time too that's taken away.
Right. And Mr. Katz is probably up on this. If life insurance isn't properly owned, that also gets included into the federal estate. So some people think that they're properly planning, and in actuality, they're actually adding to the 55% or whatever that number is. One of the other questions I have, and I think that one of the things we see is the heirs are sometimes forced to break apart the family business in order. And is that basically what you're saying? Is something happens to your father, basically it's...
Yeah, there isn't a big bank account somewhere with enough money in it to pay the estate tax. So we would have to come up with it somewhere. We'd have to, I don't know, you'd have to get out of certain lines of business, maybe liquidating some of the inventory that we have. You'd have to close down a branch. Somehow you got to come up with that money, and it isn't just sitting there. It's all invested back into the business.
So your brothers and sisters, would you be willing to say that they would do better with that up to 55% of that money, or would the federal government do better with that?
I think we could handle it a little bit better, yeah.
These are tricky questions, I know.
I'd like to make a comment if possible.
Yes, ma'am.
We keep talking about how it's going to affect all these small businesses, and it does affect some small businesses. But according to the statistics, as I said, when there was a $3.5 million exemption, only 4,425 small businesses were subject to the estate tax, while there were over 22 million small businesses filing income tax returns. So although it does affect some, and I appreciate how it affects them, but we have to look that it's not every single small business, and most small businesses have been made so fearful that even the corner barber shop is afraid that he's going to lose his business to the estate tax, and he's not even going to be subject to it.
Very good. I appreciate that comment. I got 1 minute left here. If maybe we go to Mr. Flesher on this one. If the death tax was fully repealed, would you use the capital to hire more workers, purchase more equipment, or otherwise invest in your business?
We'd continue to invest in our business and grow our business. And, not only our families, but we have long-term employees. I've got employees that have been with me 26 years, 24 years, 20 years, 18 years. It's not just one or two. So, and these employees are fully vested in this business and may have an opportunity to take over that business or part of that business as well. So the ongoing investment in the business would be a definite.
Yeah, it's one of those things, if you want less of something, you tax it more. And unfortunately, none of us in this room are going to get out of this world alive. So, but I thank you all for coming. Thanks. I yield back, Chairman.
Thank you, Mr. Schilling. I now turn to Mr. Shabbat from the great state of Ohio.
Thank you, Mr. Chairman. Well, first thing that comes to mind, the Democratic witness for the death tax here just made a statement basically saying that there aren't that many businesses that, after all, have to deal with this. We're talking about 3,000 plus. But it's my understanding that it really affects a lot more than that in a lot of different ways. Would any of the other witnesses like to respond to that argument that we hear periodically that it really doesn't matter that much because there's only a few businesses that it really applies to, so it doesn't affect anybody else? Could anybody else respond to that?
Well, to those of us that would be affected, it is a big deal. So the fact that there's 3,000 family businesses that are affected, maybe to the average American is like, well, that's just 3,000 people. To us, it's our business, and it's those 90 families that are employed by us, and it's our customers and our vendors. It's a much bigger piece of the pie than just saying, well, it's just this one family. So,
Mr. Fisher, I see you nodding. Would you like to respond?
Well, speaking for our association, we're a very capital-intensive business. So every one of our businesses not only has their properties, but the expense of running that business, we don't just have an office set up and run a computer. We have to buy equipment and replace equipment every year. Every year, just to stay even, we have to reinvest 10 to 15 or even 20% just to maintain our inventory. And then when you consider that during better economic periods, we're going to try to create more growth, we have to invest heavily year after year. So almost every one of our businesses is definitely affected by this law.
Mr. Katz, did you want to say something?
Although only 3,000 or 4,000 businesses are affected on an annual basis, that doesn't mean that all of the other businesses aren't out there dealing with this. In our law firm, we do a tremendous amount of planning, succession planning and planning for closely held businesses. And even to those people that are not necessarily affected on an annual basis, they're involved. They're involved in planning. They're involved in spending money on attorneys, thankfully. They're involved in spending money on insurance premiums to be able to deal with liquidity issues. It does take up a lot of time and effort and energy, and it can create some incredible stress. Having to sit in front of somebody like Ms. Madonia's father and say to him, the only way for you to really deal with this is for you to transfer interest in your business to the next generation now, to start to take advantage of some of the rules that are out there. And to have him look at you and say, well, that's all fine and nice, but I rely on this business to live. This is my income. If you start moving interests around, how am I supposed to survive? I don't want to, and with all due respect, I don't want to ask my daughter for money when I need it. And so while there may only be 3,000 or 4,000 small business owners who die during the year who are impacted by this estate tax, it is impacting a lot of people. There are a lot of people planning and dealing with this every single day. There are conferences for lawyers who do estate planning, thousands and thousands of lawyers learning about this. If there are thousands of lawyers learning about this, there are hundreds of thousands of people that are dealing with this every day.
Thank you. Is it fair to say that particularly in a tough economy like we have now and have had for a number of years now, at a time when businesses are trying to stay in business and be competitive and focus on what it is that they do to create money and wealth and jobs for their employees, that a lot of these business owners, their time would be more efficiently spent concentrating on their business and how to make it better and therefore to be more successful and hire more people than to perhaps have to focus so much time on how to keep the government from taking this from them at some point in the life of this business. Would anyone want to address that? Or you can just say, yep, that was a good point, Congressman.
That was an excellent point, Congressman.
Thank you very much.
I certainly think that goes without saying.
Thank you. I've only got a couple of seconds left, so I thank all the panel members here for their input in this. I know I've been speaking about this for a long, long time, and I would argue that you all know a whole lot better how to spend your money than the federal government does, and we ought to let you keep it and get this economy moving and hire more people. Thank you.
Thank you. I now turn to Mr. Bartlett of Maryland.
Thank you. You know, if an enemy had the ability through an ether wave to permeate our minds and induce us to do something really hurtful to ourselves, he might find it difficult to do better than the death tax. Chairman Walsh and Ranking Member Schrader, thank you for allowing me to participate in this hearing. As we have heard, the estate tax has disastrous consequences and is the most unfair tax that the government imposes. At a time when we in government should be removing obstacles to small business growth, the estate tax provides a roadblock to small business survival. But there are solutions, and I am particularly pleased to recognize Mr. Jack Fitzgerald, who is here today. Jack is a prominent Maryland businessman and friend of mine who studied the estate tax problem from the business point of view. He founded Americans Standing for the Simplification of the Estate Tax Asset in 2010 in order to change the collection method for the estate tax. He believes that as long as the IRS requires the estate tax to be paid, there is a simpler, more compassionate way to collect the tax that would reduce the impact of the tax and avoid the loss of the family-owned businesses at a time when they are already dealing with the loss of a loved one. I would like to congratulate him for putting together a grassroots group which includes private businesses, family farms, and individuals. I think that the asset solution as a bridge to phasing out the estate tax is well worth studying, and I am pleased that the committee has agreed to include it in the record of this hearing. In his testimony submitted for the record, Mr. Fitzgerald notes that he has paid nearly $700,000 a year in after-tax dollars for life insurance to cover the possible estate tax liability arising out of his automobile dealerships. Mr. Fitzgerald and others have maintained that many small businesses over-purchase life insurance in order to prepare for the estate tax. In your experience, is this a common occurrence in the small business sector?
I can't say that I have a lot of clients who have spent that much on insurance every year, but yes, it is a common occurrence for people to look to find a way to create liquidity to be able to deal with estate tax obligations. And one of the most significant ways to do so is to acquire life insurance, properly owned life insurance, and to hold that life insurance to deal with the estate tax obligations. Now, not everybody is insurable, and not everybody has that opportunity to buy insurance. Not everybody has the cash flow necessary to pay the insurance premiums each and every year. So while insurance is a solution, it's not the only solution to the problem.
The case for tax reform is dramatically illustrated by reviewing the data cited by the Congressional Joint Economic Committee in May of 2006. And what they found generally was that the cost of compliance was just about equal to the revenues the federal government collected from this. Could there be a dumber tax than this, where the cost of compliance equals the amount of money which the government collects from this? Can you please share with the subcommittee your assessment of the conclusions by the Joint Economic Committee?
I personally don't understand where that number came from. I mean, I know that there are things that have to be done. There are things like trusts, which should be done whether there's an estate issue or not, which I've documented in my written testimony. I've seen there are documents that need to be done if they're doing partnerships, if you have trust returns, but I know what estate tax returns cost, and I have yet to file an estate tax return that costs more than the amount of tax collected.
Well, I was quoting from their Cost and Consequences of the Federal Estate Tax, page 17, and you might check that if you question their study. Subcommittee has received testimony for the record from Mr. Jack Fitzgerald, founder of the Asset Coalition, which advocates reform of the current estate tax on behalf of small business owners. In his testimony, Mr. Fitzgerald asserts that private capital is locked up in unproductive trusts to escape estate tax liability, meaning that many of the best business minds in our nation are forced to sit idly by and can't create new wealth with their assets because they must lock them away for their heirs to inherit. In your experience, is this a common experience in the small business sector?
Again, when the first person dies, we usually fund a B trust. We call it a B trust, and assets are put into that trust up to an exemption amount. There is a problem, as I see, when you have to fund that trust with a closely held business stock because you don't get the dividends passed out or the income passed out to the surviving spouse who may be looking for a way to supplement their income that they've lost when their spouse died. But there is no provision in the code that prevents that trust from owning another business, starting another business, or investing that in some way to help business growth.
Thank you very much for letting me sit in on your subcommittee. Thank you.
Thank you, Mr. Bartlett. Thank you all for participating today. The estate tax is a critically important issue for small businesses. As evidence of that, the subcommittee received numerous requests from associations representing small businesses, including the National Federation of Independent Business, the Food Marketing Institute, the American Trucking Association, the American Wholesalers Marketers Association, the International Sign Association, and the Marine Retailers Association, that their statements about the negative impact of the estate tax be included in today's record. I ask unanimous consent that members have 5 legislative days to submit statements and supporting materials for the record. Without objection so ordered, the hearing is now adjourned. Thanks.